quite carefully. We have position data day by day and contract month by contract month for both futures and options at the individual trader level. That's the information we share with the Commission in the closed surveillance briefings each Friday. And as you know, we have looked at numerous complaints and looked at the trading intraday and examined those particular instances. I can't comment further on the results of those, or else I would be revealing, as Dan said, the positions or strategies of individual traders. As to whether there's a physical shortage in terms of supplies that are available in warehouses, we have not seen any difficulties with the delivery process in recent years.
Thank you, Commissioner Chilton. Commissioner Amalia.
Thank you. Mr. Sherrod, you did a great job in outlining the global nature of these markets. Can you give us an example of how these things are traded and priced on a daily basis?
Well, for example, on a daily basis, I'll probably get the name slightly wrong, but I think it's the London Silver Market Fixing Limited conducts that daily survey led by the chair. There are 3 banks in that group, and they go to customers and they discover a clearing price, and that price, for example, is used for cash settlement by the Dubai Silvers futures if someone takes a cash settlement option there instead of making or taking physical delivery. So some of those price discovery mechanisms that are in place around the world are widely viewed as reliable and used as a basis of commercial transactions. And price discovery occurs in COMEX, certainly, in around the globe in the visible and public trading markets.
Could you also touch on the relationship to ETFs and the rise in their investment in those classes of funds?
Well, ETFs provide a mechanism for, at least the ETFs that we're familiar with, for holding physical gold by the ETF and for a small investor to buy a share in the ETF. As the small investors make their independent decisions to buy shares, the ETF responds by buying the physical metal. And likewise, as the individual investors make their decisions to sell their shares, the ETF responds by selling the physical metal. So they are linked through arbitrage to our markets, but those particular ETFs, the leading ETFs in gold and silver in particular, don't hold futures contracts.
Do you have any concerns about their investment strategies in relationship to futures markets?
I think it's important to note that the ETFs that I've mentioned, the ones that are actually holding the physical gold and silver bullion, don't have an investment strategy per se other than to match their investors' demands in shares with holding of the physical metals.
I just wanted to ask one, thank you, Commissioner Amalia, just for Mr. Sherrod, page, it's 17, it's this one, so I don't know if they're different numbers. But I just want to clarify, the green line on here is from one set of reports, our commitments and traders reports that come out weekly, and it suggests that there's a 40 to 60 short in the producer merchant category. The blocks are from a monthly report that labels things differently, and it suggests that the short, give or take 40 on this, is in the banks. So am I to take that, I mean, sometimes we think of banks as swap dealers, and in this case, it doesn't line up. Without getting any particular names, but could you just help the public and the Commission understand?
Sure, and I'm going to do this very generically, as you mentioned, without getting into names. Banks have, for very long periods, decades, been very active merchants in gold and silver. And for example, the 5 members of the London Gold Market Fixing Limited that publishes the 2 daily gold fixes that are publicized on the London Bullion Market Association are Bank of Nova Scotia, Barclays Bank, Deutsche Bank, HSBC Bank USA, and Societe Generale. The 3 banks in the London Silver Market Fixing Limited are Bank of Nova Scotia, Deutsche Bank, and HSBC Bank USA. So there's a long history of banks being involved in the metals markets.
As merchants, you're saying?
As dealer merchants, right?
I see. Okay. I didn't have any other questions. I don't know if any of my fellow commissioners have any, but I don't. Not seeing any other questions. I want to thank our panelists, and if our, I think it's officially our second panel, could come up, we greatly appreciate that. There will be a break after this panel. I'm now just checking. Let me thank you all. It's really an honor to the Commission that you've all come and help us and help the publics learn about these precious and base metals markets and the possible consideration of federal position limits and exemptions there too. If it's possible that each of you, I know you have written testimony that's going in the record, but if it's a chance to sort of summarize in 5 minutes, that would be really helpful so that we could get to some questions. There will be those lights over there that help out. Doug, Leslie, no, it's right here on the panel. And I hope that's not rude of us, but you'll see that happening. I'm just going to go from left to right, but Tom Lasala from the CME group and has, I think, testified before us, but we see you so often, Tom. I'm not sure.
Specifically before the commission. No.
All right. Well, then it's terrific to welcome you here for the first time testifying before the full commission. I hope you come away feeling it was terrific as well.
I hope so.
And then I'm just trying to read because my glasses aren't good, but Jeremy Charles from HSBC, who's Global Head of Precious Metals for HSBC, and I thank you so much for taking the time to be with us. Mark Epstein, who is an individual trader in these markets and has a long history trading on COMEX, NYMEX, and CME and CBOT on various activities, but has been very active in the metals markets. Jeff, if you can help me with your last name, just so that Burkhart, Jeff Burkhart, who's the Vice President, North American Metal Procurement of Luvada, Buffalo. But this is a global manufacturer the public may not be as aware of, but global manufacturer in the copper-based products and has over 6,000 employees, 30 production facilities in 18 countries. So it's very helpful that you're here today. And then just turning to my notes to myself, but then we have, and you're going to help me with your name so that we don't.
Yes, Chairman, it's Dermot O'Hagerty.
All right.
Dermot is in deer and mid.
What's that?
Deer is in deer and mid. The U doesn't help at all.
Oh, all right.
Yeah, it's one of those
Dermot.
It is, yes.
O'Hagerty, and who joins us as Deputy Chief Executive of the London Metal Exchange, that metal exchange that was being so discussed and is so central to these markets. He's been there for over 10 years, first as General Counsel and Head of Enforcement, but was more recently, I guess now, a handful of years ago, promoted to the Deputy chief executive, which I would guess make you the number 2.
I like to think so, yeah.
All right, that's good. So I thank you, all our panelists, and we'll just, Tom, if you wish to start, and we'll go across.
Thank you, Chairman Gensler and Commissioners, for this opportunity to present our views on position limits and hedge exemptions for U.S. regulated exchanges. I'm Tom LaSala, Managing Director and Global Chief Regulatory Officer of CME Group, Inc. I'd like to take a few moments and make brief points, and then be happy to take your questions. Excuse me. First and foremost, excessive speculation in our markets and other metals markets has not occurred and is not a threat to orderly markets. Commission-set position limits are not warranted by any subjective evidence. Second, the CME Group's position limit and accountability regime for our highly successful COMEX metals markets fully comply with our regulatory obligations under applicable core principles, and users of our markets value our transparent and well-regulated metals markets. To ensure uniform understanding, allow me to describe that regime. We apply hard limits in the metals beginning the day before the delivery month. At all other times, we employ accountability levels. Each day, CME Group market surveillance analysts review their markets to identify entities over the accountability thresholds. On a weekly basis, a report is presented to Market Regulation Management for additional review. During the period from January 2008 to February 2010, our surveillance staff exercised authority granted under the accountability rules on 28 occasions and issued instructions to entities either not to increase their position or to reduce their position. Additionally, the surveillance staff monitors deliverable supplies in order to anticipate potential congestion or delivery problems. This regime fully complies with the CEA and Commission regulations and is administered by the exchanges with Commission oversight. Third, recent fringe complaints by organizations such as GATA regarding allegedly depressed gold and silver prices are not supported by any credible evidence and lack any viable economic theory. Their claims are not representative of our broad customer base who value our well-regulated and well-functioning metals markets as complements to the much larger and global metals cash markets. Fourth, the supply, demand, inventory, and available trading venues and instruments and the price discovery alternatives in the global metals markets illustrate that a futures market hard position limit regime and restrictions on hedge exemptions would have no positive effect or impact on the global price discovery process or world supply-demand equilibrium. Most likely, restrictions in the form of position limits on significant traders on U.S. regulated markets would simply inspire a shift of volume from U.S. exchanges to instruments and markets beyond the Commission's jurisdictional reach. For example, the volume of copper futures contracts traded on COMEX in 2009 was only 7% of the volume of copper futures contracts traded globally. Platinum futures traded on NYMEX in 2009 represented approximately 40% of the volume of such contracts traded on exchanges worldwide. But cash forward and ETF markets have taken over a major market share. And with respect to gold, for the 3-year period ending January 2010, the number of ounces of gold actually delivered between clearing members on the LBMA system far exceeded the volume of gold traded on COMEX, with the exception of November 2009 and January 2010. The gold traded on LBMA dwarfs contracts of gold traded on COMEX. And I note that the numbers on LBMA are net deliveries. They are not the total volume that is traded throughout a trading session. Aside from the loss of business to U.S. companies, any policy that moves trading off regulated markets conflicts with the Commission's stated goals of strengthening market efficiency and integrity. Moreover, such action would undercut the national policy of enhancing market transparency, a policy that was reaffirmed by Congress in amendments to the CEA in 2008 and is being pursued today by Congress in its efforts to reform regulation of the financial system. Thank you, and I look forward to your questions.
Thank you so much, Mr. LaSala. Mr. Charles. Hold our questions and then try to do it as a panel.
Chairman Gensler, Commissioners and staff, my name is Jeremy Charles. I am Global Head of HSBC's Precious Metals business. I would like to extend my thanks for the opportunity to join this panel today and to share some views on the subject of potential limits and exemptions for precious metals trading on the US futures exchanges. I have worked in the wholesale gold and silver market for 35 years, and the global business that I manage today is a significant user of the precious metals products offered by US futures markets, as well as other significant markets and exchanges around the world. I have submitted a statement which I hope goes some way to describing how commercial institutions operate at an industry level and how participants such as HSBC use the futures markets as part of our everyday activity in precious metals. We do believe that gold and silver are fundamentally different from the domestic agricultural commodities and from the energy products, and I trust that I have provided sufficient detail in my statement with respect to that. The fact is that the US futures markets are an important component of the global precious metals trade. The liquidity and transparency they provide, along with the cleared nature of the contract, is very appealing to the industry. It should be remembered, however, that there are many markets around the world that could all provide similar services to the US markets and which can quickly step in should inappropriate or overly burdensome restrictions be placed on the US markets alone. The free movement of liquidity among all of the global markets is a key factor in ensuring a level playing field for all participants, and it is the global trading, hedging and market-making activities, particularly by the wholesale commercial participants, that aid in maintaining more orderly markets with better price stability, notwithstanding local supply and demand attributes of individual markets. This is a vital consideration for the Commission when discussing potential limits. And without the ability to freely trade and hedge, it may be the US market that could find itself disadvantaged in terms of pricing and liquidity relative to other markets. HSBC, like other commercial institutions, frequently maintains open positions on the US futures exchanges. But as you may know from previous inquiries, positions of this nature are typically hedged against positions established in other markets, particularly the London cash market. If it wasn't for the ability of these commercial institutions to finance and warehouse physical cash positions in London, for example, which are then hedged against short futures positions in the US market, then it may significantly restrict risk management activities as well as the liquidity that would otherwise be available to investors seeking to establish and or maintain long futures positions at economic rates. As far as consideration for any exemptions, I cannot emphasize strongly enough the importance of the commercial participants in the US precious metals futures markets. The US futures markets for precious metals have gained a supreme reputation from participants as a fair, transparent, liquid and well-regulated market, where rules covering large position reporting and accountability levels already fulfill the goals of regulators in terms of ensuring appropriate behaviour by all market participants. I completely understand the need for the Commission to consider and investigate whether the implementation of additional limits is appropriate for each of the commodities markets. But certainly in the case of gold and silver, I believe that firm position limits are unnecessary, and were they to be imposed, it could be detrimental to the markets here in the US. I have in my statement commented on concerns on the imposition of position limits and the application of exemptions, and would urge the Commission, should you determine to impose any such limits, to carefully consider in detail clear exemptions for bona fide hedging, risk management and market-making activities. To summarise, the US futures exchanges are but one of many choices that exist for investors, institutions and end users to deal in precious metals. The free movement of liquidity among these various global markets is a key driver in providing the worldwide precious metals trade with transparent, economic, fair and liquid pricing. Thank you.
Thank you, Mr. Charles. Mr. Epstein. You might want to push the button. There you go.
Thank you. Good morning, Chairman Gensler, Commissioners, fellow panelists. My name is Mark Epstein, and I'm an individual trader in the futures markets. Thank you for the opportunity to participate in this panel discussion. I trade nearly every business day in all of the active futures markets listed on the CME, including metals, energies, interest rates, agricultural products, currencies, and equity indices. And I'm a member of the CME, the CBOT, NYMEX, and COMEX. I received a bachelor's degree in mathematics and a master's degree in computer science from the University of Chicago, and I've been involved in the futures and options markets for nearly 25 years. Initially, I worked as a technical analyst, researcher, and computer programmer, but for the past 10 years or more, I've also been the trader. Currently, I trade for my own individual account. In all of the futures markets that I participate, I'm a market maker. I provide liquidity. I make two-sided markets nearly all day long. Using computers, I'm able to quickly adjust my markets in real time to respond to changing conditions and to manage the risks that I'm taking. I'm a short-term speculator responding to the ebbs and flows of prices, buying and selling, and I go home each night with either more money or less money than I started with at the beginning of the day. I tend to close out my positions, so I rarely have overnight risk. Each futures market has its own individual personality. They all behave differently, and I know a lot about the personality of each of the markets that I trade. I place orders to buy and sell, working to make profit while avoiding danger. Second by second, or even millisecond by millisecond, I have decisions to make and orders to place. To me, the markets are a complex puzzle of moving numbers. But behind the scenes, the markets are actually real people, real products, and real activities, especially in the commodities markets of finite supply. Today, I'm here to speak about the metals. I make markets in COMEX gold and silver futures, sometimes copper as well. And I typically trade between 1,000 and 2,000 futures contracts in the metals every day. I can tell you all kinds of statistics about the markets and the prices, but let's just take an example and look at 10:15 a.m. on February 4th, 2010. Somebody seems to have been in a rush to sell gold that day, and in less than a quarter of a second, they sold about 2,000 futures contracts, driving the price down instantly 100 ticks. This represents 200,000 ounces of gold, or about $215 million worth of gold at the time. It was a very big trade, and it took place in the blink of a second, in the blink of an eye. There aren't many players in the gold market capable of playing that big. And I'm not sure what motivated them to decide to overwhelm the price of gold instantly, rather than selling more slowly. But this kind of thing happens in the metals markets almost every day. Not even India's move to buy $6.7 billion worth of gold from the IMF on November 3rd created this big of a disruption to the action of the actual futures markets. Today, I'd like to speak primarily about COMEX silver. I've traded silver for a few years, but I've only become particularly interested in it when I started to buy physical silver, back in May 2008. At that time, silver was trading at about the same price it is now, around $17 per ounce. But in between then and now, silver took a journey down to about $8.25 an ounce and visited a high as about $19.50 an ounce. And I traded every single price in there. The futures markets for commodities of finite supply are very interesting, and to maintain their integrity, there must be a tight relationship between the futures prices and the physicals prices. This attracts speculators to participate and develops an effective marketplace for price discovery, which assists bona fide producers and consumers of physical commodities to hedge the price risks in their businesses. I follow the price of COMEX silver futures and the prices of physical silver market. Near the end of 2008, there appeared to be a divergence taking place between the price of COMEX silver futures and the price of physical silver. So I bought some silver futures, and I took physical delivery of 1,000-ounce bars from the CME, melted them into 100-ounce bars, and sold them in the retail marketplace. This price divergence lasted for a couple of months. And I wasn't the only one who noticed. The warehouse stocks of physical silver at COMEX dropped about 20 million ounces as people realized the cheapest way to get physical silver on the planet was by draining the inventory from COMEX. Currently, the COMEX silver warehouse stocks are down to about 115 million ounces. The accountability limits at COMEX silver are 6,000 contracts or 30 million ounces, with the delivery month limited to 1,500 contracts or 7.5 million ounces. I believe this is too high. Additionally, the current open interest is about 114,000 contracts or 570 million ounces, almost a year's worth of mining production. From the commitment of traders reports and the bank participation reports, it appears that the largest single position is held by a bank on the short side, and the size of that position is currently about 30,000 contracts or 150 million ounces, which is about 120 million ounces larger than the current accountability limit. Presumably, they must have been granted an exemption to the position limits, but this seems wrong to me. Exemptions should only be granted to bona fide hedgers. In studying the micro-price movement personality of the COMEX silver market, I can tell you that it behaves like no other market. The typical available liquidity in the deck is tiny, yet we have average daily volumes in excess of 40,000 contracts. And as a result, there is significant price volatility for the markets to absorb large orders. The existence of oversized market participants has a chilling effect on the market makers, which results in even less liquidity as market makers widen their prices to compensate for the increased risks they are taking, including myself. Consequently, the large orders wind up setting the prices, rather than the proper function of futures markets to discover prices. The size of the open interest in COMEX silver is irresponsibly large, given the reality of world inventories and production. Additionally, there is a significant imbalance between the largest long positions and the largest short positions, with the shorts being heavily concentrated. In a physically delivered futures contract for a commodity of finite supply, this also exposes the marketplace to an unnecessary risk of failure to deliver at the COMEX. Such an event could destroy the COMEX silver market. I'm encouraged with the CFTC's stated intention to implement a consistent policy for position limits in all commodity markets of finite supply. For COMEX Silver, I think the position limit for all markets should be reduced to 2,000 contracts, with delivery month limited to 1,000 contracts. And most importantly, exemptions should only be granted to bona fide hedgers. Thank you.
Thank you, Mr. Epstein. Very interesting testimony. I like the part, some days you go home with a little bit more money and some days with a little less money. Mr. Burkhart.
Thank you. Good morning. First, Mr. Commissioner, fellow commissioners, I'd like to thank you for the invitation to talk today. I am Jeff Burkhart, Vice President for Luvata, but I'm testifying today on behalf of the Copper and Brass Fabricators Council, and we appreciate the opportunity to present our view in this matter. The Council is a nonprofit membership trade association whose members produce over 80% of all the copper and brass products made in the U.S. Absolutely critical to the Council members is the availability of copper units at commercially viable prices. In the last several years especially, the copper market has been subject to previously unprecedented fluctuations. The Commission's open meeting today to consider futures trading in the metals market is timely. It is our belief that investment funds have been the major driver behind the record high prices we have seen in many commodities in recent years, including copper, the primary raw material in our business. These high prices, which we do not believe are warranted based on fundamentals, have caused major challenges for our industry, including increases in working capital and even more damaging substitution. One only has to look at the copper industry to see the disconnect between fundamentals and price. Since January of 2009, the price of copper has increased over 100%, while at the same time the quantity of material stored in warehouses has also increased over 100%. Thus, while the copper market was in surplus, the price more than doubled. Because of these high prices primarily, but also the high volatility, we completely support the CFTC in taking action to reduce the influence of investment funds in commodity markets. Commodity markets were established to be the benchmarks for determining prices for the underlying commodity. This has always been, and we believe should be, their primary function. However, today it seems as though they've become primarily investment vehicles, with prices many times having little correlation to cost or fundamentals. We believe that if funds were to have smaller positions in the markets, it would greatly reduce the volatility, bring prices more in line with fundamentals and cost. These results would be beneficial to our industry, our customers, and to the economy in general. However, while we completely agree with the Commission that this situation warrants careful attention and we would like to see action taken, we'd like to offer a different method to accomplish this goal. We feel the method you are proposing would be very challenging to implement effectively. The questions that you sent out on position limits highlight the complexity of this method. Issues such as developing quantitative methods, a percentage or a fixed number of contracts, spreads, trades, exemptions, etc., highlight the complexity. In addition, if limits were set high enough, they could end up impacting few, if any, firms. We would like to suggest the CFTC consider a different approach to this challenge. It is our belief that imposing significantly higher initial margin requirements for investment funds would be a more effective solution. While imposing position limits would potentially affect a few large funds, if any, raising the initial margin requirement would affect all investment funds immediately. While imposing position limits could achieve a goal of reducing speculation, we see higher margins as a better solution. Raising the initial margin offers several advantages. First, the system is already in place. Funds or speculators are already charged a higher amount for initial margin than hedgers or manufacturers. The fact that the system is in place and being used today offers a significant advantage of ease of implementation and should minimize any confusion. The approach should also be much easier than position limits to monitor and control, as it eliminates the deal with many of the questions which arise when trying to manage position limits. Again, this change would immediately also affect all funds across the board, regardless of size. This is another advantage compared to position limits. For these reasons, we feel that increasing initial margin amounts charged to investment funds or speculators will be a more effective solution to the problem. However, in any solution that is implemented, we would not want to see position limits put on hedgers or see initial margin change for this group either. Futures markets are critical for us to use in establishing prices and being able to manage the price risk in our business. We only use future markets as necessary in our day-to-day business to protect or to hedge our price risk, and it's critical we can do this in a cost-effective manner. In summary, lower volatility in prices that reflect over time the real supply-demand situation, not the excesses of speculation, would both be very beneficial to our industry. We fully support the CFTC in looking to limit the impact of investment funds in commodity markets. However, we would appreciate your consideration of using initial margins as the approach to accomplish this purpose. However, regardless of the approach taken, the Copper and Brass Fabricators Council would be glad to work with the Commission if we can be of any assistance in developing an effective solution, and we appreciate being able to be here today on this important topic. Thank you.
Thank you, and Mr. O'Hagerty.
Thank you, Chairman, and thank you, Commissioners, and I'm very grateful to be invited to give evidence here today. I've been asked to briefly give a picture of the London Metal Exchange as a copper market, and I've provided slides and various information, but I'm not going to talk you through them because it will take too long, but we can talk about them later. The London Metal Exchange operates futures and options markets in 7 industrial-based metals: aluminium, copper, zinc, lead, nickel, tin, and aluminium alloy. These are our mature markets where the daily LME official prices have become the accepted reference prices for the world trade in those metals. Copper has been traded on the LME since 1877. Today, the LME copper market has delivery locations in the US, Europe, and Asia. The slides I have provided give a picture of the physical nature of the LME contract. For example, copper brands that are good delivery against the LME contract represent 59% of the world production capacity in 2009. The LME is an on-exchange forwards market. Each LME futures contract is an obligation to deliver metal against payment on the settlement date. On a trading day, the available settlement dates are every business date out to 3 months, every Wednesday out to 6 months, and every third Wednesday in the month out to 10 years. Settlement of LME futures contracts is first by offset and then by delivery of the balancing positions by means of LME warrants. This takes place on the settlement date, so ownership of metal changes hands on the day. There is no settlement window. An LME copper warrant is a bearer warehouse receipt that represents the ownership of a specific 25 tons of an identified producer brand stored in an identified shed operated by an LME-approved warehouse company. The warrants even specify the number of bundles in the lot. The slides show the volume of copper that was delivered in, stored, and delivered out of LME-approved warehouse sheds in 2009. The LME devotes a great deal of effort to maintaining the brand listing and warehousing systems because the reliability of metal stored in LME-approved warehouse sheds underpins the integrity of the trading and therefore the price discovery. The daily settlement system means that anyone who does not want to or is not able to deliver a warrant against their net short position due to settle tomorrow had until 12:30 London time today to postpone delivering by rolling that position forward by a day. This is referred to as Tom Next trading, i.e. Tom for tomorrow and Next for the next day. The evidence of a settlement squeeze is the backwardation price that a short position holder has to pay to buy the Tom Next spread. I've provided a copy of an LME notice that explains how the LME lending guidance protects the market from settlement squeezes. In effect, a dominant long position holder is obliged to lend to the short position holders by selling the Tom Next spread at fixed rates. I've also provided a slide that gives an information on Tom Next copper trading during 2009 and a slide that shows the number of times large positions appeared in open interest figures for each of the 3 months forward. One last point, the LME receives position reports by 8:30 a.m. each morning that give the total positions for each broker and each of its clients for all settlement dates, as of the close of business the night before. This allows the LME to have a total picture of the market, to group together connected positions, and therefore to apply the lending guidance. The LME also, the rules also give the LME the power to ask for OTC positions if there are on-exchange positions that need to be explained. You have the slides, so if you would like me to go through any of them, I might. If I have a bit more time, there are 3 slides, I think, that give an interesting picture. The arbitrage between the Shanghai Futures Exchange and the LME is not possible for most people to be a cash arbitrage. You need to physically take metal out of one and deliver it into the other. So slide 4 shows the LME share of futures traded copper over the year, and you'll notice it dipped in July. That means Shanghai futures trading increased. If you then go to slide 7, this shows LME stocks in warehouses over the period. Now, one of the points is there's the total stock figure at the beginning of the year and the total stock figure at the end of the year, but you also get the net deliveries in and out, and you can see that more metal went in and out than actually stayed. But also the interesting one there is green is Asia, and during the July period, there was no metal in LME stock warehouses in Asia. That doesn't mean it wasn't going in. It was going in and coming out, but not staying. And then finally, slide 13 shows the Tomnex trading, and the blip there where there was a small backwardation for Tomnex trading is in July. That shows how connected the markets are. Thank you.
Thank you to all of our panelists for excellent testimony. I'm going to ask a couple questions and keep myself hopefully to my own 5-minute round. I had a question. It's probably to Mr. Charles and Mr. Epstein, but anybody have a view? And it's particularly around some of the slides that Mr. Sherrod had earlier about the concentration in the precious metals markets, particularly in the silver market. But in comparison to the energy markets, that slide suggests it's a more highly concentrated market. And Mr. Epstein said each of these markets have a personality. And one of the slides even showed that the particular concentration on the short side of the marketplace. So without, going into individual trading strategies, but what's the nature of the market, particularly in the silver market, that these publicly available information suggests the large concentrated short side of the marketplace? Either Mr. Charles, maybe.
Oh, thank you. Of course, I'm in a position where I know what HSBC's position is, but I'm not aware of what everybody else's position is.
But you're in a position where you can share your views from the seat that you sit in.
The positions in the short futures positions in on the futures markets, as I've mentioned in my statement, they are hedged against contracts primarily in the local London market, certainly in our case. And the reason, I can't comment on why there is such a concentration. We use the market as a mechanism, as a hedging mechanism against our OTC, against our cash positions. And the reason we have cash positions is for a number of reasons. We obviously trade in the market. We're a market maker. We're hedging client activity. And we also use the cash against futures positions to manage our liquidity positions. So I need to be long of cash. I need to hedge that, so I'm short of futures. And I use those cash positions to provide physical services to our clients and also to provide loans to our clients as well. So that's the reason why we maintain such a position of that nature.
So if I could just explore that, I'm sorry, but so if you're on the short side on the COMEX futures, the long cash position is as a merchant? I mean, is it that you're providing physical bars of silver and gold?
Yeah, absolutely. So we maintain a cash position in London, which is in a physical bar form. London's a physical market. So we maintain a long position in the physical markets. The reason we do that is so that we can provide our clients with the services that we supply to them.
And is that largely vault silver then?
Yes, it is.
And it's so you're not sort of shipping it out and shipping it in, but it's just
no.
physically
The metal is against the short position that certainly we maintain anyway. We hold metal in the vaults in London.
I see. Mr. Epstein, did you have a view on this?
The idea that, if somebody has a big pile of silver and they wish to avoid price risk, then it's natural to sell silver futures. That's the role of the futures markets. If you imagine we didn't have futures markets at all, it would be terrible. The CFTC's role is very important, and the CME does a great job in providing liquid, highly active futures markets. The issue in silver specifically, I looked at silver yesterday, I traded it, and I was kind of curious, were there things about the short concentration that came to the forefront yesterday, for instance? And there was, one example, 8:37 and 53 seconds Chicago time. Somebody decided to sell a little bit of silver, similar to how they sold 2,000 gold contracts, back a few weeks before. And they only sold 272 silver contracts, and silver dropped, 14 ticks, which is almost 0.5%. That's only 270 futures contracts, but they did it in 50 milliseconds. When you look at gold, gold dropping on 2,000 contracts, 1%, earlier, it's the size of these, the capability of people, whether they're banks, whether they're individuals, whoever they are, to take a risk position to sell 2,000 futures, or if somebody sold 2,000 futures in silver, it'd be limit down instantly. I mean, the market can't absorb that. If there weren't these big monster guerrilla traders out there in a market that's that small, there would arrive a much more robust market-making community. The markets would be much more effective at finding prices.
Thank you. I just wanted to ask Mr. Haggerty a question. In December, the FSA, you're regulated by the FSA, or
yes.
no? All right. The FSA published something around over-the-counter derivatives. I'm going to ask my question in the second round because I'll keep myself to the 5 minutes. But I want to ask you about how they use position management authority in London. Commissioner Dunn.
Thank you, Mr. Chairman. Mr. Epstein, I'm going to pick on you just a little bit here, not because you're a silver trader, but because you're a mathematics degree from the University of Chicago, which, in my opinion, is the epicenter of high-frequency trading through algorithms, which is what you have, in essence, developed in your program. And you talk about the big monstrous traders out there. Do you see somebody on the other side of you using a much more powerful program than you might have?
Well, everybody that's trading in the futures market is buying or selling, and there's a counterparty to every transaction. It's a fair game. If I make money, somebody else lost it. If I lose money, somebody else made it. The CME as a forum, to allow buyers, small, large, to come in and out and place orders quickly, slowly, however they choose, is a fair playing field. It's FIFO. The first person who gets the order in, trades with the first person that got the order in the other direction. So whether somebody on the other side of my trade is large, I'm primarily providing liquidity, which means that I'm willing to buy when customers or other people in the world come in to sell, and I'm willing to sell when people that need to use the markets come in. People that are providing liquidity are kind of the core speculators to a futures market, whether they're in the pit years ago waving and yelling and screaming their hands, or they're programming computers these days. So I see it as a very fair market, and I think it's crucially important. The problem is if people come in, I mean, one person, whether it's a bank or somebody that wants to, throw $5 million around, $10 million worth of silver, can massively disrupt the market very, very quickly. The market itself is small as a result of the big players having the ability to throw around large size.
If I could just make a comment, my expertise is on copper, not silver, but he talked about, the impact that these large players have. A little history on copper. If we look at 2002, copper moved around less than 15 cents in the entire year. That was the range from high to low, okay? Now we see ranges of 15 cents in a day. And it's the same thing in our market. Somebody comes in, takes very large positions in the trade, which I'm representing today, are not large enough to offset those positions. And you see volatility in a day, more in a day than you used to see in a year.
Mr. Epstein, back on your program, and you talk about the 3 milliseconds that you might have as a heads up on something. Are you co-located with your position?
I am co-located at the CME. The CME has a wonderful program that's available to anybody to basically place their computers at a specified data center and get access to be able to buy and sell quickly, and it's available to anybody.
Again, I apologize for picking on you, but I just found your testimonies so intriguing. I got a lot of letters, I imagine the other commissioners did as well, concerns about unable to purchase silver in the retail market. at a particular time. You seem to be able to get around that by taking delivery. Is that something anybody could do?
I was kind of curious about it, and it was really easy. You know, I bought some futures contracts, as I do all day long, but rather than selling them to lock in a profit or loss that day, I noticed the exchange that I wanted to take physical delivery. Once I took physical delivery, I coordinated to have a truck pick it up. They took it out of the exchange. The metals that are sitting at the exchange, the 115 million ounces that are there right now, when I actually took delivery, nothing happened. They just gave me a warehouse receipt that said, these are your bars, and you can keep them there. And everybody at the exchange and my clearing firm said, are you really sure you want to take these things out? Because once you take those physical 1,000-ounce bars, each of them weighs about 75 pounds, off the exchange, if you want to sell them again to the, on the futures markets, you have to get them reassayed and to be able to put them back in the exchange legitimately, and it's an expensive process. So once you take them out, you got them. You know, you're not putting them back to sell to in the futures market very easily. But I decided to try it out, and I took them and I melted them and I sold them in the physical market. And this really exemplifies how important it is for the futures markets to track physical markets. If you're trying to hedge your gold or silver, and the futures markets are mispriced by whether it's 50 cents, $1, or in that situation, $2 or $3, it's ridiculous. The futures markets are no longer serving their purpose. And everybody that noticed this and decided to take the initiative to try it out, took physical bars at the cheapest that they could be found on the planet from the COMEX. COMEX could have lost all their bars. They have 1,500, 7.5 million is the most ounces you can take in delivery month. A half a dozen people, 7.5 million ounces isn't that much for people. So they could have drained it.
I know my time's up, but it begs the question, what would happen if they drained the reserves of the COMEX?
What would happen? I think, number one, Commissioner, I don't think you would drain the vaults in the COMEX. Number two, I think that if prices dictated that there was a high demand for metal, metal would come in to the COMEX vaults. Remembering back to that global market, Loco, London, traders would see that arbitrage and bring metal in and replenish supplies. I'm not sure, quite frankly, what market Mr. Epstein sold his metal in, but I think someone questioned shortage in like a consumer chain. That's very different from the COMEX market. There have been certainly, I've gotten emails about individual investors saying, this is, I've got high prices for coins, how come the COMEX is so much cheaper? The answer to that is simply, we're not a coin market. There's all kinds of steps in between and handling and middlemen to go from a COMEX bar to a finished coin.
I thank you, Commissioner Dunn. I'm sure we'll keep following up on this. Commissioner Summers.
Thank you, Mr. Chairman. I'd like to ask Mr. LaSala if he'd be willing to comment on Mr. Epstein's testimony on how the markets work at COMEX, and if you could give us an idea of how they're comparable to the other markets you surveil, especially the energy, the differences between how metals markets may compare to the energy markets.
Well, I think it's, the first thing I'd say, Commissioner, is, relativity, meaning that COMEX metals markets, I think as some charts were up earlier by Mr. Sherrod, are not the largest in the world by far. So there's going to be a relationship between COMEX markets and world markets. We're not going to, certainly I'm not saying we're not going to be a price discovery mechanism, because to many, we certainly are relied upon, but we're not going to necessarily be the driver. Furthermore, again, depending on the market, some of the energies are going to be more liquid than some of the metals. Some of the metals are going to be more liquid than some of the energies. For example, gold is going to, broadly speaking, be more liquid than some of our smaller New York Harbor energy products. So they're all different. The structures of these markets have, in effect, changed in some regards with the advent of electronic trading. I'm not sure if Mr. Epstein ever stood in the pit. If he did, he's not standing there anymore, as it just seemed that the way when NYMEX moved to implement electronic trading, at least in the futures markets, there was more of a move, it moved pretty radically away from the floor. And that definitely, I think, had an impact on people that traded in that pit community, where when you were standing in the pit, there was almost a swell. That you could feel the market. That sounds, somewhat odd, but there was a certain feel that was attained by being in the pit. There's no feel coming through that computer terminal anymore. So, the market now is more global than ever. I'd like to say, in many instances, more liquid than ever. In some regards, some of these markets certainly are more volatile than others. And generally speaking, the smaller the market, the more apt it is to be affected by orders in it. To his comment earlier about an event on a certain date, I don't know what occurred that day. Was it someone putting in a large order, an error, when the book was particularly shallow? But that certainly can occur. I wouldn't, however, conclude that that was necessarily linked to in any way parties that have quote-unquote concentrations. So in answering your question, again, I think it's all a matter of relative standing between the markets.
If I have time for one more question, I have another question for you with regard to the bona fide hedge exemptions.
Sure.
And if you could give us an example on either why you grant an exemption to somebody or why you wouldn't grant an exemption to somebody, and then on the other side with accountability levels, why you may look at someone's position and decide that it's justified versus looking at somebody's position and deciding it's not.
Very good. I'll start with the hedge exemption. Obviously applicable for the pendency of the front month. What we would be looking at, with exemptions, and just to be clear to the Commission and to the public, these exemptions are not granted just simply in a blanket capacity, meaning that it's not in gold where there's a 3,000 contract limit. You're exempted and you do as you please. You apply to us and you stipulate to us, give us your book, so to speak. What is behind the position? And we don't grant that exemption, as I said, just open. It's going to be for a finite number. What we're cognizant of in granting that number would be, is the underlying exposure there? And number two, in granting that position limit exemption, have we created a concentration? So I can give you examples, whether it be in metals or in energies, where large entities, I have no doubt in my mind that they've got the underlying exposure that they're asking for the exemption. I just can't give them the level of exemption they may seek, because that size in and of itself could in fact cause a concentration, could in fact cause an anomaly in terms of pricing. With regard to accountability, I think you know, and by Mr. Sherrod's presentation, those accountability levels are at historical levels, meaning they're very small. We kept them that way. I pushed to keep them low to, quite frankly, maximize my ability to reach in when I thought it was appropriate. That stated, one of the key concerns that we seek to address in accountability inquiries is, quite frankly, around concentration. And I can tell you that we certainly, as demonstrated in the written testimony, and I mentioned in my oral, and during a 14-month period, we documented 28 particular instances. Some of those would be certainly to commercial players, and I have to tell you that I would say that some of those commercial entities might not be pleased because, again, they have the corresponding exposure, but I'm looking at a greater picture, that being just simply the orderly operation of the marketplace. And to also just be clear and well-rounded, in a given month, because that accountability level is low, we may have certainly checked out, when an entity came in the market, who they are, what type of operations they conduct. They may be in excess of the accountability in a particular month, and the percentage of the marketplace is so low that other than the fact that we're always sensitive to activities in the market that could be manipulative or whatnot, that concentration doesn't pose a threat.
Thank you, Commissioner Summers. Commissioner Chilton.
I want to thank all of you for your testimonies. And before I start with Mr. LaSalle, I just want to say, I think CME does a good job. We didn't have any major defaults during this economic fiasco. There wasn't a problem at your exchange or on the futures markets in general. So that said, it doesn't mean that we don't have issues, and I think there are some. You tout, as Commissioner Summers was talking about, the accountability levels. And you note that you have taken 28 actions, and I want to make sure that everybody's clear. Those 28 actions, those weren't just in the metals complex, right? That's 28 actions in all of the contracts?
No, that's not correct. That was in the metals contracts.
Okay, and thank you. I'm glad I clarified it. And of those in the metals contract, what you say is to maintain or reduce. So some of your actions were to say everything's copacetic. Do you have any idea how many of them were to reduce positions?
I don't have that information with me. I'd gladly supply
But
it to
maintaining
you.
says, well, they violated it, but it's okay. So whatever.
I'll be clear when you say they didn't violate really anything.
Right, they didn't violate a thing. No rules. Okay. So did you instruct any shorts to reduce their positions during that time?
I don't have those stats in front of me. I would say
no problem.
we can
Okay.
double check and circle back to you. My guess would be yes.
If there's no objection, if you'd like to provide that for the record without objection, Mr. Chairman, is that appropriate?
Absolutely, yes.
Okay.
We'd be happy.
If you feel comfortable doing it. Okay.
Would be happy to subsequently submit it to you.
So were there any enforcement actions taken with anybody who violated these accountability actions? Any fines that were levied?
There is at least one matter pending.
Okay, one matter pending. Okay, so you took 28 actions in the metals complex. Some were to maintain, some were to reduce, may have been on the shorts, and there's one case. But as Mr. Sherrod talked about, in the last 2 years, we have an average of 18 abrogations. That may be a too strong a word, but examples of traders exceeding the accountability levels. That's in gold, up to 28. For the average, this is the average time that traders are in violation, I'll take your word, have exceeded the accountability levels 4 times, and at one point there's a maximum of 7. So, I think you can argue, people can make their decision on the merits of it. I think you can argue that, from your perspective, the markets are okay, and maybe these levels don't impact, and everything's all right. But to argue that the position limits are working, I think, the statistics aren't on your side. Okay, Mr. Charles, I'm curious, you mentioned exemptions, which I appreciate, and you talked about the need to legitimately hedge your business, your customers. Can I take it from that you would not be opposed to having an exemption that would restrict your ability to trade in excess of the accountability levels or a position level for your own book?
Sorry, can you just repeat that again, please?
Okay, you've got an exemption, and your testimony was that you need such an exemption for your customer's account, to be able to cover their hedging. But would you agree that you, for your own book, for your bank, that you shouldn't be allowed to use your bank's funds, not your customer's funds, in excess of the accountability or position limits?
Well, we would use the exemption to satisfy the hedging of one contract against another. As I think I explained, that we take positions in the futures markets that are equal and opposite to the cash market. I think that's a general misconception that there are large open short positions out there. There's certainly the positions that we run are matched off against the OTC or against the cash contract, primarily the local London contract.
If I said you could only go above the accountability level or the position limit for your legitimate business of your customers.
The issue there is, what is the legitimate business for our customers? Because of course,
from your
that would be extremely difficult, in my opinion. Okay. It would be.
Could do it, which it might be, like I say, might be a headache. If you could do it, would you be opposed to saying that you can't trade in excess of the accountability levels or the position limits for your own book? It's a proposal that, by the way, is in our energy proposal to do just that.
Well, I would find it extremely difficult to differentiate that because, of course, you know, as I explained earlier, there is a reason why we do the hedging that we do. There's a reason why we hedge cash against futures. We need the cash positions to be able to service our customers.
All right. Well, I want to ask you about the Volcker rule then. Thank you.